If you own software stocks right now, you're probably asking one question. Is this just another dip, or did the game change? Because in late January and early February 2026, software got absolutely smoked. And not just one or two names. The whole group got repriced, like investors suddenly woke up and asked, wait, do we still need all these apps if AI agents can do the work? Today I'm breaking down 1. Why software stocks are tanking, 2. What's panic versus what's structural, and 3. A practical plan for what you should do next, without making a move you regret for the next 10 years. Let's start with what we can measure. The software sell-off has been broad. One popular proxy for the sector is the iShares Expanded Tech Software ETF, ticker IGV. Over the past month, it's dropped about 20%, and it's down roughly 23% year-to-date as of the February 6 close. And the damage wasn't a couple bad apples. During the slide, about 97 of IGV's 110 holdings were trading below their 200-day moving average. That's not a vibe. That's a technical, the entire group is weak signal. Reuters reported the S&P 500 Software and Services Group had shed around $1 trillion in market value since January 28 in this wave of selling. So what was the match that lit the fire? The market's spark was Anthropic. Anthropic rolled out Claude Cowork, an agentic mode meant to execute multi-step work, and open-sourced a set of plugins that turn Claude into a specialist for functions like legal, finance, sales, marketing, customer support, and enterprise search. That launch didn't break any company overnight. But it did something that matters in markets. It changed the story. It made AI feel less like a feature and more like a substitute worker. And when investors smell substitution risk, they hit expensive software first, especially the kind priced per seat. Okay, now let's go deeper, because that spark fell onto dry tinder. Reason number 1 is the obvious one. Agentic AI is forcing investors to rethink the software business model. Most SaaS companies charge per seat, per user. But an AI agent doesn't need 50 seats. One agent can do the output of multiple humans, and it can run 24/7. So even if a company still uses your software, it might buy fewer seats. That's what people mean by seat compression. And the reason this matters is that per-seat revenue is the foundation of a lot of software valuation models. If Wall Street believes seat counts can flatten or shrink, the multiple changes fast. Now here's the bigger idea that doesn't get enough airtime. For the last decade, software has been an interface economy. You pay for the interface humans use to do work. Dashboards, workflows, forms, approvals, tickets. But agents push us toward an outcome economy. In an outcome economy, you don't pay for the interface, you pay for the result. Close this support ticket, generate this report, draft this contract and flag risks, ship this feature. That shift is brutal for software businesses that mainly sell interfaces, because the agent can hop between tools, automate the clicks, and make the interface less valuable. It also explains why the sell-off wasn't equal. The market hit text-heavy and automation-friendly categories first, especially where the software is basically a middle layer, legal and compliance workflows, generic content marketing tools, document processing, and some developer tools, because AI coding assistants are getting more agentic too. A lot of people are calling this the vibe coding era, where code gets produced quickly by AI, and the human becomes more like a reviewer than a builder. If that becomes mainstream, it changes how companies buy dev tools and how many developer seats they need. Now, does this mean software is dead tomorrow? No. And this is where you need to hold two thoughts at the same time. Thought number 1. The market is not crazy to reprice risk. The direction of risk changed. Thought number 2. Plenty of people think the sell-off looks overdone because these AI agents still make mistakes, they still need oversight, and regulated work doesn't tolerate mostly right. In fact, some commentators are already framing this as an overreaction, a future buying opportunity, eventually, while others say it's a genuine reset. The key isn't AI kills all software. The key is AI widens the range of outcomes, and wider outcomes mean lower multiples. That's the first force. Reason number 2 is the boring one. Valuation math. Software is a long-duration asset, meaning a lot of the value investors pay for is in cash flows expected years from now. So when interest rates are meaningfully positive and growth becomes less certain, the valuation multiple can compress hard. Think of it like turning up gravity on future profits. The Fed's target range is in the mid-threes, and the 10-year Treasury yield has been hovering a bit above 4%. That's the discount rate backdrop for the entire market. So you combine a higher discount rate with new uncertainty about growth, and you get multiple compression. This is how a company can still beat earnings and still go down. Because the market isn't just reacting to last quarter, it's repricing what it's willing to pay for the next 5 years. Reason number 3 is positioning. Software was a crowded trade for years, and when a crowded trade breaks, you don't get an orderly decline, you get a stampede. The trigger doesn't have to be bad fundamentals, it just has to make investors want to de-risk at the same time. And we saw capitulation signals. Jefferies noted that around 73% of software stocks were screening as oversold during the move, which is basically an extreme everyone is selling reading. Oversold doesn't mean it can't go lower. It means the selling pressure is intense and broad. And when selling becomes forced, from momentum funds, risk models, and people panic selling because they can't emotionally handle volatility, prices can overshoot. That overshoot is why some investors are calling this a garage sale, and others are calling it the end of SaaS. It's the same chart, 2 different emotions. Reason number 4 is the sneaky one. Big tech's AI spending spree is pressuring the whole ecosystem. Multiple reports have pointed out that mega-cap tech is planning enormous 2026 capital spending for AI infrastructure, chips, servers, and data centers, on the order of hundreds of billions of dollars. That creates 2 problems for software stocks. Problem 1. Investors worry about ROI and free cash flow for the big platforms. When the platform's free cash flow gets questioned, the whole growth at any price complex gets repriced. Problem 2. Corporate tech budgets get squeezed. Even huge companies don't have infinite budgets. They have priorities. If leadership suddenly decides AI infrastructure is priority number 1, everything else becomes negotiable. That means longer sales cycles, more scrutiny on renewals, and pricing pressure on nice-to-have software. And if you've ever worked in a company, you know exactly how this goes. It's not cancel everything. It's we love your product, but we need a discount and more flexibility. And markets hate that. Okay, so those are the 4 forces. Now we go from what happened to what do I do with my money? Here's the plan I'd use if software is blowing up your portfolio. Step 1. Figure out which investor you are. If you own broad index funds, S&P 500, total market, target date, your move is boring. Keep contributing, rebalance if needed, and don't let a sector headline hijack your plan. Because you're diversified. Software can have a brutal year, and you still finish the year fine. But if you're concentrated in software, a software ETF or a basket of SaaS names, you need to manage concentration first. Because if a 25% sector drop makes you want to rage sell, you don't have an intelligence problem. You have a position sizing problem. So ask yourself this. If this position dropped another 25%, would I still sleep at night? If the answer is no, reduce the position size. Not because you called the top, but because your portfolio should match your nervous system. That's personal finance. Step 2. Triage your software exposure into 3 buckets: fragile, fortress, and picks and shovels. Fragile looks like per-seat pricing with easy seat compression, low switching costs, and features that can be copied or bundled by a bigger platform. Fortress looks like system of record software, mission-critical workflows, deep integration, real switching costs, strong free cash flow, and customers who can't just turn it off. Picks and shovels looks like usage-based billing, data platforms, observability, and cybersecurity, the infrastructure layer that AI still needs to run. The point is not that fragile equals 0 and fortress equals safe. The point is, in a reset, fragile models can stay cheap for a long time, and fortress models tend to recover first because they still have leverage. Step 3. Use a quality checklist before you buy anything. Here's my quick checklist for 2026 software. 1. Pricing model. Seats are more exposed. Usage and outcomes can be more resilient. 2. Moat. Do they have proprietary data, distribution, ecosystem lock-in? Or are they basically a user interface with a logo? 3. Financial strength. In an uncertainty regime, cash flow matters. Debt matters. Margins matter. 4. AI execution. Are they actually monetizing AI or just demoing it? Because a demo doesn't pay for itself. And yes, you'll hear people talk about the rule of 40 in SaaS, and more recently even a rule of 60 for the best AI-enabled businesses. Don't worship the number. Use it as a filter. Does this company combine real growth with real profitability? Because in this environment, growth at any price is over. Step 4. If you're in a taxable account, consider tax loss harvesting carefully. If you're sitting on big losses, you may be able to realize those losses and use them to offset other gains. But respect the wash sale rule. Don't sell a holding for a loss and rebuy the same or substantially identical security within 30 days. Usually you swap into a similar, not identical exposure, so you stay invested without triggering a wash sale. If you don't know what counts as substantially identical, ask a tax pro. It's worth it. Step 5. If you're buying, scale in. Do not try to be a hero and call the bottom. Pick a timeline, like 6 to 12 weeks, and average in, or rebalance gradually. That way, if it drops again, you're not emotionally destroyed. And if it rebounds, you're still participating. Step 6. Know what not to do. Do not go on margin to buy the bottom. Turn this into an options casino. Or sell everything after a down 8% day because the headline scared you. Volatility is the price of admission. Your job is to not get kicked out of the game. Now, what should you watch to figure out if this is a short panic or a longer reset? Here are 4 things. 1. Renewals and pricing. On earnings calls, listen for phrases like pricing pressure, seat expansion, seat contraction, and budget scrutiny. 2. Billing model shifts. Companies will start experimenting with usage-based and outcome-based pricing. If a company can successfully charge for outcomes, it's more aligned with the agentic world. 3. Net retention. If customers are spending more over time, that's a sign the product is still sticky. If net retention slides, that's the market telling you seat compression is real. 4. Platform risk. Watch what Microsoft, Google, Amazon, and Apple bundle into their ecosystems. Because if the platform gives away 80% of what a standalone tool does, standalone tools get repriced. This is why middleware is the danger zone. So here's my honest take. Part of this move is panic. And part of it is a real regime shift. The panic is believing one product launch means every software company goes to zero. The regime shift is that AI agents will change how software is sold. Fewer seats, more usage-based and outcome-based pricing, and more pressure on nice-to-have tools. So the right stance isn't sell everything, and it isn't buy everything. It's selectivity and risk management. Software isn't disappearing, it's being repriced. And if you have a process, repricings can become opportunities instead of disasters. So here's your takeaway. Software stocks are tanking because the market is repricing uncertainty. AI disruption risk, valuation math, forced selling, and budget pressure. What you should do is control what you can control. Diversification, position sizing, tax strategy, and the quality of what you own. If you want to follow up, comment reset and tell me what you own. Software ETF, mega caps, or specific SaaS names. And I'll make a part 2 on the kill zone versus the safe havens. Like, subscribe, and I'll see you in the next one.